Chapter 6 has some key features regarding income statement format and the costing that we do for inventory. According to generally accepted accounting principles, the cost of inventory manufactured in a facility includes the direct materials, the direct labor, and manufacturing overhead, as we've learned in the past. This is for a manufactured item. This traditional inventory costing technique is also known as absorption costing, and the reason it's called absorption costing is it fully absorbs all manufacturing cost of the item. Another format that you will be introduced to in this chapter is called variable costing. So of course we already went through the chapter on determining a variable versus a fixed cost, and if it was mixed we broke it into its components. So we know that material varies with the number of units that we're building or producing. Same with labor. The assembly of the units that you manufacture will increase or decrease depending on how many units you are making. Okay, so direct labor is also variable. Now you may think that there may be indirect costs associated with your direct labor force, essentially when they're off duty or they're not actually working on a product, so not on the clock kind of time. In that case, those costs incurred for not actually assembling a product are charged to indirect. So only the direct labor content is actually charged to jobs. Okay, so again, there is a variable relationship there with labor content. And of course, we know manufacturing overhead typically has both variable and fixed components. If I was doing a variable costing, I would want to separate out only the variable cost, obviously by the term and the definition of a variable cost. All right. So what's the purpose of doing this? GAAP requires that we report inventory at traditional costing, full absorption costing. Okay. So variable costing is used for internal management purposes. Okay, and you're going to see that that's how it's used in a company as you proceed through this chapter. Okay, it is used by management in evaluating management team, controlling inventory levels, and the profits and costs within the organization. Since only variable costs are included in inventory values that pass through to the balance sheet, the fixed manufacturing overhead under this scenario is treated as a period cost. We never did that before. If it was manufacturing cost, it was a product cost. So this is a difference, an exception. Okay? And again, it does not comply with generally accepted accounting principles. So keep in mind that this is used for internal purposes, not external reporting. Okay. I'm going to show you just a short example here, and it actually relates to one of the problems that's coming up, but maybe you'll see how it works a little better if I show you with numbers. Okay, I've put two columns out here. One is absorption costing and one is variable costing, and we're trying to compute the product cost under each of these methods. Okay, remember again, absorption is GAAP, variable costing is not GAAP. Okay. Well, we said that material, labor, and overhead are the component costs of product. So direct material falls under absorption costing as well as variable costing because direct material is a variable cost. It is included under both methods. Likewise with the DL or direct labor portion. Variable manufacturing overhead again is also captured under both methods. Now here's where we differ. We know that overhead has both variable and fixed, and we broke it up into its two component costs. We did this using the high-low method, or an actually better refined method is called regression analysis, but we didn't spend much time on that. That one's a little bit more complex. You can use Excel, you can use a calculator to do regression analysis, but it uses a number of points, not just the high and the low. Okay, so just coming back to the numbers are already given to us typically. So what we're looking at, okay, is that the variable component piece obviously is in both, but the fixed component is only recorded as part of the cost under absorption costing. It cannot be under variable because it's not a variable cost. Okay, so how did I get this $30 here? Well, I'm just using this particular example. If our fixed manufacturing overhead cost in a period of time, like a month perhaps, includes things like salaries of the supervisors that are overseeing the manufacturing process, the rent on the building or on the equipment that we use in our manufacturing process, the insurance costs, the part of the electricity costs, because obviously the variable cost related to running machines would be variable, but the fixed cost includes things like turning the lights on, so we have power and heat in the building, right? So again, fixed manufacturing overhead could be a variety of different types of costs. Depreciation is one of them. Okay, this is then divided by the number of units that are produced in the period. Okay, so that would be a manufacturing per unit cost then, $30, and that's how we got that. Now you will see in the problems, they will give you the number of units sold and the number of units produced. The intent is for you to think your way through this. If I am a manufacturing facility, I'm not worried about how many are sold yet. I need to produce enough so that the sales force can sell them. So the cost is going to be allocated over the units produced, not what happens later, the sales of those units. Okay, so be careful there. You're going to have to use the correct denominator. So in computing these two specific costs, for the example I illustrate here, the difference is the $30 a unit. So keep in mind that inventory cost sits on the balance sheet in the inventory account, finished goods when it's completed, until it's sold. Once it's sold, we take it out of finished goods and we move it to cost of goods sold to match it against the revenues generated. Okay. All right. I'm throwing in a couple words of caution here. Selling, general, and administrative costs, SG&A, are never a product cost. So even though we changed the fixed manufacturing, how we see or use that value under variable costing, and we now changed it to a period cost as well as the selling, general, and admin, you're going to ask me, why did we make it a period cost? And there's a really good explanation for it. If I have a manufacturing facility, and say we own the building and we own the machinery that's inside that building, if I produce 0 units, I still have to pay the cost of the building, the rent, the insurance, the supervisor that's there. Obviously, I would lay off the supervisor if we're never going to produce anything, but we're just in startup. So essentially what you have would be kind of like a graph of cost, and it's fixed, right? And hopefully by now you know what a fixed cost line looks like, or a cost curve, we call them, even though it doesn't curve. It's pretty linear. Okay, so that curve, linear relationship basically, exists at parallel to the x-axis. So if I have 0 units or 1,000 units, it doesn't matter. I still incur the cost. So if that's the case, I still incur the cost. Doesn't matter how many units I make. So why should I pass that cost through the inventory account? It's a period cost. It's the cost to operate the facility for the month, whether I make anything or not. So that's the interpretation that the management accounting is putting on it. Okay, or management puts on it at this point in time. Okay, so that's the reason they call it a period cost. They want to expense it in the period incurred. They don't want to manipulate the cost of the inventory based on my capacity costs. Okay, and I use the word capacity costs because obviously the size of the building, the amount, the number of pieces of equipment we have, those are all going to regulate the capacity for how much work I can actually produce. Okay, so what do we want to do with that? Well, there's going to be a couple things, okay? Even though we have to do absorption costing to provide external information to the auditors, to the government, to the bank, okay? We want to measure management performance. How does the plant manager measure up to other facilities, to within our own company? We're not measuring up against other people in the external marketplace, because that would be confidential data and I wouldn't want to share that. So in essence, The variable costing is the technique or tool that I use to evaluate, is the plant manager managing inventory levels properly? Is he generating profits based on the units that he's producing and that our people are selling? Okay, or is he manipulating his profits by producing excess inventory and thus hiding some of his fixed cost on the balance sheet? And so the inventory on the balance sheet keeps growing and growing because he keeps building more inventory. And then one of these days I'm going to go in and say, oh my God, how did we get to $500,000 of inventory? We usually only run $100,000 in inventory. So I'd want to say, you were measuring me always on the bottom line, whether our facility was making a profit. So I was producing to make a profit so that, corporate would be happy. Oh yeah, but you did it at the expense of adding all this inventory that our sales guys can't even sell. So now we have all this product and we can't do anything with it. And I'm wasting company resources. So this is where this shift into variable costing came into play. All right, so that's my little intro on this chapter. And before I take off into the next segment, I have just a couple minutes to tell you about part 2 of this particular chapter. Part 2 talks about a segmented income statement. And what you'll see in a segmented income statement is basically by region, by product line. You want to look at, is the product line or that segment or that region making money, or is it being hidden by our corporate overhead costs? So we're going to look at how do we segment out, our contribution margin, our segment margin, and then finally our operating income for that facility.